Hi, everyone. Welcome to Tax Talk Unfiltered, presented by Gelt. I'm Spencer Carroll, CPA and account executive, joined by Rachel Richards, CPA and head of product here at Gelt, and then Tal Binder as well, CEO of Gelt. And yes, we are
Yeah.
three tax nerds here to talk about all things tax. There's a lot going on, things are changing all the time, and we're happy to have these conversations and share it with you guys. So, today we are going to talk about some of Trump's proposed tax changes. Keyword proposed, nothing happens for real until Congress actually signs something, but it's fun to talk about. So, I'm going to share my screen, and in today's episode, we're talking specifically about changes to your individual tax return. So, to start, I'm going to scroll down here and I'm going to open the floor. We've got a couple different options for the SALT deduction. SALT standing for state and local taxes. And there's, I think, four different options here. We can repeal the deduction, make it permanent, but double it for married couples, make it 15 or 30,000, or just eliminate the income and sales tax deduction portion of SALT. So, Rachel, I'll start with you. Maybe which one's your favorite and why?
I can't say that I have a favorite, but I think it's really interesting that they have four options that are really totally different from each other. Because on one hand, they're doubling the deduction, on the other hand, they're taking it away completely, and then there are some in betweens. So I don't necessarily think that one is better than the other, but they're definitely just really different. I think for a long time, it's been kind of a position of the Republican Party that, by having the state and local tax deduction, the federal government subsidizing the state income tax. Because if you're living in a high income tax state, you're getting this deduction, where if you're living in, say, Florida or Texas, you're not getting that deduction. So that could be a reason why maybe they would want to take it away completely to level the playing field.
Go ahead, Tal. What do you think? What's your favorite, if you have one?
Well, I'll start with that. The first thing is that it's, I think, kind of surprising that we don't see something that completely eliminate the cap, because just before 2017 there was no cap. Just to be clear, like before Tax Cuts and Jobs Act, no caps at all. Everybody claimed that, and I think that during the election, I think that Trump said that he would actually just cancel that. So it's interesting to see that, as far as I know, or as far as I see, maybe we'll be able to see it somewhere there, that
No,
Nope.
it's
they
not there.
didn't put that
Yeah, that
option. Am I
not
wrong? Like,
included.
did I miss anything there? Yeah. So I'm with you, Rachel, that it's a bit like understand the logic about subsidizing the higher income state. That's total coincidence that it tends to be Democratic states as well, but personally, it really depends better for who. Because for a lot of business owners and a lot of this kind of like cap is really it's hurting the most like higher income people basically. And each one of the states also like created their own kind of workaround for certain businesses. So business owners felt it a bit less. The ones that at least knew about the workaround and could take advantage of that. But mostly it hurts like people who pay a lot of state and local tax. People who own a house that is quite expensive, so they pay a lot of property tax. Or people who their just general income is quite high and they end up paying like a lot of like state taxes on that. So if you're a higher income individual, the more you can deduct, the better it is for you. If you are a lower income individual, and sometimes you tend not to itemize your taxes, because that's another thing, you can claim that deduction only if you itemize your taxes. You cannot claim if you're taking the standard deduction. It doesn't matter to you too much. The Tax Cut and Jobs Act also increased the standard deduction significantly. This year it's going to be around $30,000, which is very beneficial, especially for lower income families. Definitely creating more caps or keeping it the same it is, hurting mostly higher income, making the cap higher, helping higher income people, and eliminating it altogether. Also, again, it's something that it's mostly like higher income individuals are the one to get hurt from that the most. So I would say for probably 80% of the population in America, or 70%, doesn't matter that much. it really matters only for the top like 20-30% to itemize their taxes and actually need that.
Question for the two of you. Why not lower the standard deduction and then get rid of these caps and let people be more creative with their itemized deductions?
I mean, I think that would overall that could be an approach, but that would make your taxes more complicated. And I think the trend in recent years has been to, make things a little simpler. Tax code is really complicated, which does give people a lot of opportunities to find, those gray areas or find opportunities to get breaks where if we had just a flat tax or something, more standard, those options aren't available. But I think overall, just having it would put a burden on people who don't have a lot of stuff. They would need to, go through all their charitable deductions, and if they are just trying to get their taxes done, they might miss out on more things. It would definitely make hiring a professional more attractive for a lot of people.
Yeah. As soon as I asked that question, I was like, you know what? That would probably disproportionately hurt lower income people who definitely get the benefit of having a higher standard deduction because they just naturally would not have as much involvement with the salt.
A lot of people like they don't know what they can deduct or not deduct unless someone's telling them. So having that standard deduction is like, well, at least I'm getting something, and hopefully I'm in the same position that I would be otherwise.
Well, anything else to add?
Yeah, always. But the long story short, I think that you kind of like you got the point that like the complicate. I totally agree that the U.S. tax system is probably the most complicated one, at least from the ones that I learned. And I know the Israeli one, I know the UK one, and I know the U.S. one. I think that's something that a lot of Americans completely miss is that the complication is really pro lower income families. The vast majority of American taxpayers, according to the IRS, and which it is shown by the numbers, are paying very low amount of taxes in America. Most of the taxes are a burden of the top 20% of the American taxpayers. Those complications create more areas that lower income families can pay less taxes. The complication of the tax code is really beneficial for the people who need it. And it's not as beneficial for the people who don't need it as much, some would say. So that's definitely something that I think that people should take into account. That tax rate will hurt lower income families. And I think that generally speaking, like even what we saw throughout the last tax reforms in 2012, in 2017, and also in this one, all of those reforms are usually the question is how do we tax more fairly the higher income taxpayers in America? Because the lower income taxpayers in America, they don't pay that much taxes. That's the truth. That's just the blunt truth. No matter what other people are trying or what the media is trying to push on you, like if you compare it to Israel, where you start to pay almost 50% the moment that you cross about $80,000-$90,000 a year in income, you're getting to almost 50% there. And if you're looking at the UK, that the moment that you cross, I think it's $60,000 a year, you're paying 40%. You're at around 40% tax bracket. Don't catch me on the numbers, of course, but that's more or less those numbers from the last time that I checked. America got it pretty nicely, and increasing the limitation is basically asking, okay, what group of the higher income people are we going to tax more, and which group maybe tax less? And another thing that they didn't put there is that if totally fine that they put the deductions, $15,000, $30,000, $10,000. Why doesn't it attach to inflation? Why don't they attach it to the index so it can go up with inflation and it can go up with changes?
That's the next administration's
in
problem.
in income in general. Well, still, but those are lawmakers, and they are the representatives basically of us, the people, and they need to do what's the best of the greater good as a country. If they want to be fair and they want to put numbers, I think that basically a legislator that proposing almost anything, if they're putting a number and they do not like make it adjustable to inflation, I think that's a bad thing. Like,
yeah. So to wrap this one up, I think our conclusion is a little surprised that what Trump mentioned on the campaign trail, which was that he was going to get rid of the cap and go back to an unlimited deduction, is not included here. And then for our clients, which tend to skew more towards the higher earning individuals. Maybe not exactly what you want because you would like the cap to be removed, but there are a couple options here that might improve your situation and make it more likely that you can itemize, and Gelt would be happy to help you in those scenarios. I'm going to zoom in here. Eliminate the home mortgage interest deduction. Another itemized deduction to go with the SALT, but interesting here that we would either eliminate it or right below lower the interest deduction cap to 500K.
Yeah, I mean, I think with the same kind of a question that comes out of the SALT deduction proposals is, how would that affect uh, homeowners? Because your mortgage, your real estate taxes are part of that state and local tax deduction. And then here, if they're also, reducing or eliminating the mortgage interest deduction, then that could significantly impact people's ability to itemize their deduction. So most likely would affect higher income taxpayers. If you have a mortgage that's over, it used to be $1 million, now it's 750,000. Whether it goes down, stays the same, goes to 500,000, goes to zero, something totally different that's not on here. Either way, if you do have a higher principal balance on your mortgage, you could end up seeing a lower deduction. And could somebody who's thinking about buying a house could potentially impact their decision on buying. You look like you disagree with me.
No, I don't disagree with you about that. I just think that it will really screw up, like mostly the people in the middle, not so much the people at the top or at the bottom. The people at the bottom, if their house, like number one, like the mortgage interest deduction, let's assume most of the people itemize their taxes or itemize their deduction only using the mortgage interest deduction. That's the main kind of like expense that is deductible that pushes people into itemized deduction. So if they eliminate that, they reduce the amount of people that are even eligible in general for itemized deduction, and suddenly the people actually going to itemized deduction are people with like large medical expenses, large investment interest, and charitable contributions. Those are kind of like the people that are going to be even like considering to itemize. The people who have to be in those categories would usually be the richer people anyway, like richer people as a whole. If they go with the $500,000 cap also, it mostly means that people their home cost at least $600,000, $700,000 to be at least middle upper class people in general. So again, it's targeting very, very specific like group of people. Immediate effects for sure would be like that much less people would want to buy their own home. It would not make financial sense to buy versus rent in many, many cases. When you buy a house, you have like the mortgage, of course, mortgage interest, the principal, but you have also the homeowners insurance, and you have like property tax, and you have maintenance, and so much more headache. So it will change how much it's worth for some people, especially middle upper class. It might result in lower housing costs, like just like lower, like to push down real estate values in general. Because I know that I would think more than twice if that was the situation. I'm not sure if I would buy my own house because I'm paying more than $500,000 in the mortgage interest in general. So I'm not sure if I would buy it instead of renting, especially as a business owner when you can have this kind of like mixed usage of the house. So definitely something that I would keep in mind. I think another one, like it really depends how they phrase it. What happens to all the people that already have it? What's exactly happened, for example, to me or to many, many of our clients that basically use this deduction in their current tax return because they bought the house with the assumption that it will not affect them, that it will be deductible.
And so presumably that would continue, but who knows?
Right.
And who knows if, if
That's,
either of these would
yeah,
even
but
become law
we don't
too.
know until they actually
These
put it.
are all just proposals.
True, true. Yeah, for sure. I think that the last thing about those, for the richer people, the top, let's say 1, 2, 3%, because their mortgage is already higher than the current limitation, which is $750,000, what a lot of them are doing, instead of like they are paying down their house in cash, then they're taking a loan against their house, and they take the loan proceeds in order and invest it in the market, because there is no cap on like investment interest deduction. So the richer people are already utilizing strategies to kind of like bypass the $750,000 anyway. So it would really hurt people in the 20 to 95 percentile in most cases, and not so much like the top like 1-2% as a whole, which
Well,
is
there are
another thing that
caps
is
on your
quite
investment income
interesting,
interest deduction.
interesting to see.
It's just it's to the extent that you have income. So as long as your investments are performing well, then it would be deductible.
Yeah,
While we're on the topic of interest deductions, and this is one that's getting taken
of
away,
course, of course.
but something that I thought was interesting, and I've got to scroll down a little bit, so bear with me here, is there's a new interest deduction that is introduced.
For vehicles, right?
Yes, which I found to be interesting because I think my initial read of the situation, which there's not many details to be shared because it's a brand new concept, but people assume that it's going to be an itemized deduction like the home mortgage interest. I feel like this one will disproportionately favor higher earners and not lower earners, whereas the other proposals we've looked at have maybe been shifting the benefit to the lower earners, because I think it's hard enough for lower and middle to itemize to begin with. So they're most likely not going to get to take advantage of this. Whereas wealthier people who maybe do have the money to buy cars in cash will see it almost as an arbitrage opportunity. I'm just going to finance my car. I'll keep the cash invested elsewhere. I get to deduct the interest, and then my money's still working for me instead of buying a depreciating asset like a car. But curious to get your guys' thoughts on this one.
Go ahead, Tal.
I just don't think it's as big, and also like higher income earners, like
But
they
also
tend to
more
get like better
expensive
rates
vehicles.
on their loans
Yeah,
anyway.
and what if they took it like an investment opportunity? They buy a $1.5 million supercar, keep it in their garage, deduct the interest, and then sell it a year later for $2 million.
Most cars are not like that great of an
No, you're right.
investment.
You're right, but
At
not
the opposite, the most
not
part, the
some of
moment
the
that you touch
supercar
them, it's
categories,
30% down.
which wealthy people could take advantage of.
Yeah, I just think that I'm not sure how much exactly. Like because again, I never took a loan to buy a car, and I'm not a big car guy, so I'm not sure, and I don't know the market as much. I do see that every time that I'm getting so many ads about like cars and financing in general, you see the financing that is actually quite a low interest. Like they always, every couple of months or couple of months, they have like a quite low interest, especially if you're buying a new car. You have like, oh yeah, only like 2-3% API basically about on the car. I think that it's mostly like the higher interest is mostly on used cars, which are probably lower income people are buying more used car rather than the new car. So again, I don't know exactly how much it will affect the top tier of taxpayers. Probably again, it's aiming to kind of like for the middle. Also, it will make probably the what we are seeing the moment that there is kind of like a deduction for anything, like with the solar roofs, that they started to have credits for installing solar panels on houses. Suddenly, the whole like marketing changed, and it became, in my opinion, very predatory a little bit. That they start to market it. Hey, yeah, you're paying only $200 per month on the car, where practically you're paying like 270 or 280 or like a much larger amount. So this kind of stuff might help some people, but it will also like it will open most of the marketing opportunities for like car or like basically car companies around those. So I don't know. I don't think that it's that huge of a deal, at least for our clients or for people that I know.
Rachel, anything to add?
Maybe I'm wrong.
Not really. Something that's not clear about the interest deduction proposals in general is what it applies to. Like I'm curious to see if the mortgage interest is intended to apply to, say, real estate rental, if there would potentially be elimination or reduction in what you can deduct on your personal residence, but if you rent your home or have a residential rental, that maybe you'd be subject to different treatment. But we'll just have to see what happens.
Yeah. All right.
Can we
We've
can we
got a
talk
couple
about it?
minutes left.
Okay, I think that's a big one. I know that it will come as a shock to a lot of the listeners, but I was not born in America. A lot of the time, Americans don't realize that anybody who become a resident, even if they are not citizens, need to report their income worldwide. So anything that people created outside of the US, you need to start reporting it in America once you move into America. And as long as you are a resident, at least legal resident or a citizen in America, you need to keep reporting and paying taxes potentially on all of your income worldwide, which is very, very weird thing to do because that's America and I think Nigeria are the only countries in the world that do that. And that creates a lot of burden for Americans who live abroad. They need to think about their American taxes while they actually don't really live in the US. It's something that's constantly in their mind. I think doing something like that, it would definitely relieve a lot of the pressure on expats, but Americans who chose to live abroad and not and they have no reason to pay taxes in the U.S. Also, it can be used for tax evasion on the other side. Just to keep that in context, it might be used for tax evasion if somebody has like a big tax event, they might choose just like to relocate to somewhere with much less taxes during that period and come back after a couple of years because they don't have to pay taxes. It really depends on the language that they are going to use.
This proposal was really confusing to me because I feel like a lot of the other proposals are kind of focused on bringing things into the US and keeping things here, where this is a huge benefit for being an American living outside the US and earning income, where we potentially we'd be giving up revenue. So I was just really surprised to see this here. I'm interested to see what happens.
Yeah. Really interesting and important to remind folks that these are just proposals. We've got to wait and see what really happens. And a decent amount of the Tax Cuts and Job Act passed by President Trump in 2017 could be expiring at the end of 2025 if nothing happens. So we expect something to happen this year, but it's not official yet. But thank you, everybody, for listening. Hope you enjoyed. We want to hear from you. Let us know if there are any topics that you want Tax Talk Unfiltered to cover, and we'd be happy to shoot an episode and nerd out some more on some different tax topics. But thanks, everyone. We'll see you next time.